On the surface, China's trade data looks pretty encouraging. March's trade balance bouncing back from February's nasty deficit to a near $8 billion surplus. But that recovery is built on unexpected declines for both exports and imports, which sagged a painful 11.3%. Ouch. According to RBS's chief China economist, the fall in imports is a big concern and suggests a weakening in China's own economy. That would in part explain Beijing's domestic focus in its recent mini-stimulus package, with fast-tracked rail construction, tax cuts for small businesses, and low-income housing relief. And if you consider this chart, weaker imports aren't totally surprising either. The cost of imports obviously goes up as the RMB's value goes down, which has been the case steadily since mid-January. On the other hand, a weaker RMB should have proved more supportive to the country's export sector, something we just haven't seen. Soft exports may be more indicative of a year-on-year slump in so-called round-tripping fake invoicing done through Hong Kong, which some companies use to get around capital controls. So where does this leave growth forecasts for the Chinese economy? A Reuters poll suggests 7.3% for the first quarter. Will we actually get there? I would argue weak trade data doesn't exactly derail that possibility, but the leadership isn't making any promises. Premier Li Keqiang has made it clear the focus is on maintaining full employment rather than hitting GDP targets, suggesting investors may simply have to make peace with a new, slower China.